Have you ever looked at your bank account and thought, wait, where did all my money actually go? Not in a dramatic way. You pay your bills. You're not buying private jets. You're not ordering champagne every weekend. You work. You earn money. You try to save. And somehow, every year feels financially tighter. Meanwhile, someone else making roughly the same income somehow ends up with investments, a house, retirement savings, and actual breathing room. So what gives? Because here's the uncomfortable truth. For most people, financial failure doesn't happen in one giant mistake. It happens in tiny invisible decisions. And when you add them together over decades, the average person can quietly lose around $250,000 or more without ever realizing it. Not from scams, not from bad luck, not from one terrible investment, just from normal behavior. Today we're going to break down exactly where that money disappears and why most people never notice it happening. My name is Andrew, and I spend way too much time thinking about how everyday financial decisions quietly shape long-term wealth. If you're someone who feels like you make decent money but still can't seem to get ahead financially, make sure to hit the subscribe button and give this video a thumbs up if this helps you out, because this topic changed how I think about money, and it might change how you think too. Let's start with something surprising. If I told you someone lost $250,000, you'd probably imagine bad stock pick, crypto collapse, business failure, huge medical bill, but that's usually not what happened. Instead, imagine two people, same city, same job, same salary. Let's say they both earn $75,000 per year. Person A saves and invests consistently. Person B doesn't do anything crazy. They just spend slightly more, delay investing, carry small debt balances, and upgrade their lifestyle over time. Fast forward 30 years. The difference? Not $20,000, not $50,000, potentially hundreds of thousands, sometimes over $1 million. That's because money isn't linear. Money compounds, and mistakes compound too. That's the part people underestimate. Loss number one: waiting to invest. This one sounds boring, which is exactly why it's so dangerous. Here's a simplified example. Two people invest. One starts at age 25, person 2 starts at age 35. Both invest $400 per month. Average annual return, 8%. By retirement, person 1 ends with roughly $700,000, plus person 2 ends with around $340,000 to $380,000 different, over $300,000. And the person who started earlier didn't invest dramatically more. They just gave their money more time. Here's what most people don't realize. Compounding isn't mostly about how much, it's about how long. Think of it like rolling a snowball downhill. Early years look slow, then suddenly it becomes massive. People wait because they think, I'll invest when I earn more. But future income rarely solves current habits. Loss number 2, lifestyle inflation. Look, this one hurts because nobody talks about it honestly. You get a raise, you deserve something, bigger apartment, better car, more subscriptions, delivery instead of cooking, vacation upgrades, nothing unreasonable. But then your expenses quietly rise with your income. This is where it gets really interesting. Imagine every raise you get, you spend 80% of it, meaning if your income grows by $20,000, you only keep $4,000. Do that repeatedly for decades. That missing gap becomes enormous. Researchers studying consumer spending have repeatedly found that spending often rises alongside income, meaning more money doesn't automatically create wealth. You have to intentionally keep part of the increase. This is why some people earning $60,000 build wealth, and others earning $200,000 feel broke. Loss number 3, carrying small debt. Now you might be thinking, okay, but I don't have huge debt. Cool, that's not what I'm talking about. Let's say $5,000 credit card balance, 20% interest, minimum payments. That doesn't feel catastrophic, but interest quietly acts like negative investing. If investing compounds for you, debt compounds against you. That $5,000 can cost thousands more. And the worst part, you don't feel it because interest arrives quietly, no fireworks, just slower progress. Loss number 4, the cost of financial friction. This one surprised me. Financial friction, tiny recurring losses, bank fees, unused subscription, convenience purchases, late fees, delivery costs, impulse shopping. Example, extra $8 per day, coffee, apps, fees, random spending. $8 sounds harmless. Yearly, almost $3,000. Over 30 years, nearly $90,000 before investment growth. Invested, potentially far more. Again, not because coffee is evil, but because recurring expenses are invisible. Loss number 5, cash sitting still. This one creates arguments, so let me explain. Emergency savings, necessary, but keeping every dollar idle forever? Different story. Inflation matters. If inflation averages around 3%, money loses purchasing power over time, meaning your dollars buy less. So someone who saves but never invests may feel disciplined, yet still lose financial ground. Saving protects, investing grows. You usually need both. Why smart people still lose money. This is where psychology matters, because most money problems aren't math problems, they're behavior problems. Three big forces show up. Present. Bias. Humans naturally value now more than later. Spend today, save tomorrow. Except tomorrow becomes next month, then next year. Lifestyle anchoring. You adapt. Your new normal becomes invisible. The raise disappears. Decision fatigue after work. You don't want to optimize finances, so default choices win. And defaults are expensive. Companies know this. That's why one-click checkout exists. That's why subscriptions auto-renew. That's why financing is marketed monthly. The hidden math of normal. Let me show you something. Person A earns $80,000, saves 20%, invests consistently. Person B earns $110,000, saves 5%, upgrades lifestyle. After decades, person A may finish wealthier. That sounds wrong. But income matters less than retention. Money kept, money invested, money allowed to compound. So how do you stop losing the $250,000? Not with extreme budgeting, not with eating instant noodles. Try this. Step 1. Automate investing. Remove decisions, even small amounts. Consistency beats intensity. Step 2. Capture half your raises. Raise income. Keep lifestyle growth smaller. Step 3. Audit recurring spending. Open statements. Circle recurring charges. Cancel aggressively. Step 4. Eliminate high-interest debt. Every percentage matters. Step 5. Track net worth monthly, not daily, monthly, because net worth tells the real story. Quick story. Imagine two buckets. One bucket has a small leak. The other doesn't. You pour water into both for years. Eventually, one bucket looks broken, but the problem wasn't the water. It was the leak. That's how personal finance works. Most people focus on earning more. Few people look for leaks. And I want to leave you with one thought. You do not need to become obsessed with money. You do not need perfect timing. You do not need 6 streams of income. But you do need awareness, because losing $250,000 rarely feels dramatic. It feels normal. That's why it's dangerous. The good news: invisible losses can become visible. Visible losses can be fixed. And small changes made consistently can completely change your future. So here's the challenge. Pick one thing from this video. 1. Cancel something. Increase investment. Track spending. Pay down debt. Do one action today, and then come back a year later and see what changed. If this video helped you think differently about money, subscribe. Leave a comment telling me which hidden money leak surprised you the most. And I'll see you in the next one.